With the bond market starting to break, investors are looking for securities less vulnerable to interest rate swings. Here to talk about that is Tim Clift. Welcome, Tim.
Greg, thanks for having me.
It's good to have you. The 10-year has spent its summer vacation so far, moving in yield from 1.8% at the end of May. Now it's around 2.8%. What's your expectation for the fall when the traders come back and the Fed starts tapering? What do you think is going to happen?
I think it's only going to go higher. I think right now the market's built in this 2.8%, and they're already anticipating some tapering in September. But I think going forward, we're really still at the bottom level. So I think we've got a lot longer to go, higher to go for the 10-year.
So if rates move up, what's your best idea right now for investors who are worried about a move up in interest rates and bond selling off?
Yeah, anything that's less interest rate sensitive is better for a bond portfolio. So bank loans are where we're focusing right now. They're generally 60 to 90 day kind of maturities on those loans. So there's not a lot of interest rate risk, or really almost no interest rate risk. So you're picking up a little credit risk on one side. So there is a trade-off, and I'm not saying go all into bank loans, but it's a nice complement to a fixed income portfolio.
And what about other yield-based securities like REITs, for example, or MLPs? What's your view on those?
Yeah, I think REITs a little goes a long way. Right now, REITs are fairly interest rate sensitive. We've seen them back up. I don't see this as a buying opportunity right now. I think as interest rates drive higher, you have the refinancing issues with REITs. So we're underweight REITs right now.
And municipal bonds, whether they be in bond funds or ETFs, they've had a tough summer. And it's not just interest rates which are troubling them. It's also Detroit. It's Meredith Whitney's warnings. What's your view?
Yeah, I think just being selective within the municipal bond market, not just blindly picking out municipal bonds. You got to be careful where they're located. But I think bonds in general, most of the investors there are long-term retail investors, and they're buying and holding those, so they're probably going to be okay.
And since we're talking about yield, what about high yield or junk, whatever you want to call it? Usually trades along with the equity market. Equity market's been moving higher over the course of the summer, even as bonds have sold off. Do you stick with high yield right here?
Yeah, I think there's still opportunities. You still get a nice spread. You're still getting a 5, 6, 7% yield, depending on what types of high yield you're going after. But I think they're still attractive. I know they had a little bit of a backup recently. They dropped with the rest of the bond market. But I think it's a diversification strategy within a bond portfolio, just not staying all interest rate sensitive.
And then finally, what about stocks? Are they cheap right here? And what about dividend-paying stocks? Because if you want to find yield, you can surely find it there.
Yeah, I mean, I like the diversification strategy to dividend stocks. I wouldn't use those as a complement to a bond portfolio. I think they really should come out of the equity portion, but you usually have less risky assets in the equity markets there. What we do like better though is international markets. I'd actually, from a U.S. standpoint, the emerging markets are about 40% discounted to the U.S. The developed international markets about 20% discounted. I think going forward, we probably have more upside opportunity internationally than we do domestic.
All right, foreign stocks and bank loans. I like it. Thanks a lot,
Great.
Tim.
Thank you, Greg.
And thank you for watching The Street.